Welcome to our Introduction to Cost Segregation and the Impacts of Tax Reform webinar. We like to begin all of our webinars with a little background on our company. KBKG is headquartered in Pasadena, California, with additional offices in Illinois, Georgia, New York, and Texas. Since 1999, we have successfully conducted thousands of studies nationwide. KBKG's team has performed studies on facilities ranging in size from 10,000 to over 1 million square feet, resulting in the deferral of hundreds of millions of dollars in taxes. We also have highly qualified engineering and tax professionals on staff. Our engineering department has extensive construction experience in reading plans and utilizing RSME and Marshall and Swift cost estimation techniques. Our tax department provides support for all cost segregation tax-related issues, including 1031 exchanges, AMT, passive activity, abandonment write-offs, and lease provisions. We are a preferred provider for thousands of CPAs across the country. Now, I'll turn it over to Eddie to introduce himself.
Before I get into the topic, let me just share a little about my background. I'm a graduate student or graduate of Texas A&M, and when I was there, I studied environmental design as my undergraduate degree, and then construction management for my graduate program. So basically, I was on track to be an architect, but I've spent my career in this world of cost segregation. I joined KBKG over 6 years ago to lead our Texas-based operations. I also do quality control reviews on cost segregation studies and fixed asset studies that are done in Texas as well as other offices around the country. I'm proud to say that KBKG is very involved with the American Society of Cost Segregation Professionals, which is recognized as the primary professional organization in our industry. It's one of the reasons that I was attracted to come to work here, because of the commitment KBKG has made to that organization. We currently have 8 certified members to ASCSP, including myself. I currently serve on its board of directors and its testing committee, and I've been a past chair of the education committee. All of the cost segregation reports that I review at KBKG are signed and certified with my ASCSP stamp, which is a symbol of quality to anybody who looks at it, in particular to the IRS, who might be looking at it in an audit. I have over 37 years of experience in the cost segregation industry, and 20 of those were with the Big 4 CPA firm. So as far as our learning objectives today, we'll be taking an introductory look at cost segregation, and we'll discuss some ways that it's been impacted by the new tax law. But upon completion of the webinar, you should be able to explain what cost segregation is and how you might take advantage of it. You should be very comfortable with that. You should be able to identify tax issues that need to be taken into account in conjunction with cost segregation studies. You should be able to discuss the potential impact of cost segregation on estate planning. And you should be able to discuss the impact of recent tax reform on cost segregation. Also, you should be able to discuss cost seg opportunities as they relate to the tangible property regs. And last but not least, you should be able to identify new opportunities to immediately deduct abandoned building components, avoid recapture tax, and expense demolition costs. So with that, we'll just dive right in. Let's look at what kind of properties qualify for cost segregation studies. So in this slide, we're showing acquired property, new construction, remodeled property, and interior improvements. Those are the 4 basic distinctions of property that we end up looking at. Cost segregation accelerates the depreciation of an asset. It doesn't increase or decrease the amount that's going to be depreciated over time, but it's just taking that depreciation in early years instead of straight line over the life of the asset. A good indicator of the potential for a cost segregation study is the amount of remaining basis left in the property and how many years that are left to depreciate the property. A cost seg study should do a few things. First of all, it should identify all the short life property eligible for accelerated depreciation. It should also componentize all the real property. So due to the tangible property regulations, cost segregation studies can be leveraged now to provide more detail than ever before. And this webinar is designed to provide just a high-level look at cost segregation, but I would certainly encourage you, if you haven't already done so, to check out our other webinars that go into some of these details further. For instance, we have a complete webinar that's focused on the tangible property regulations. We have another one focusing on bonus depreciation. So there's a number of them out there that kind of dovetail together. Let's look here at an example of an acquisition of a $5 million office building. Without a cost seg study, the basis of this building will be depreciated straight line over 39 years. But with a cost seg study, the basis can be segregated into 5, 7, 15, and 39-year recovery periods, which results in an additional $1.2 million of deductions in the first year and an overall projected net present value benefit of $330,000 over the life of the property. Pretty good stuff. Here you see a visual of how a cost segregation study impacts that office building. So without the cost segregation study, the full cost of the building is recovered straight line over 39 years, as represented by the red line. And the purple line shows you how, in our current tax situation, all that depreciation that the property that we reclassified to those shorter recovery periods gets depreciated in the very first year. So you're going from 39 years straight line to 1 year on a certain portion of this property that's identified with those shorter recovery periods. So basically in this example, 1.25 million is depreciated in the first year, which includes 5, 7, and 15-year assets. And due to bonus depreciation, it's 100% bonus in the first year, so you have that strong spike, and then it flattens out. It's important to note that all types of commercial and residential rental property are potential candidates for a cost segregation study. So what we're showing here on this slide is just a very general table that describes what a cost segregation study might yield on average for different types of facilities. And you can see that different types of facilities yield different types of results. Depending on what type of facility it is and what types of functions are being performed in them, the building could be at the lower end or at the higher end of the spectrum. Keep in mind here that we didn't break this down in detail between the different recovery periods that apply, meaning 5, 7, and 15-year property. Instead, we wanted to show you the average percentage allocated in general so that you could see how these ranges can vary. One big differentiator between properties is the amount of land improvements, which can certainly vary tremendously and affect those 15-year allocations. So depending on whether 15-year property exists or not, sometimes there's none. Sometimes you have an urban location where it's a hotel and a downtown area, and the only land improvements is the sidewalk right around it. And other times you have parking lots and all sorts of things. So depending on what sort of 15-year property you have, you could be at the higher or lower end of these ranges. That's what's really moving these ranges a lot. Section 1245 property is any new or used tangible or intangible personal property that has been or could have been subject to depreciation or amortization. So when we're talking about cost segregation studies, we're always trying to identify the 1245 property in the building. Regulation 48.1c defines tangible personal property as any property except land, buildings and structural components of buildings, and land improvements such as swimming pools, paved parking areas, etc. Tangible personal property includes all property other than structural components which is contained in or attached to a building. So this would include such property as production machinery, printing presses, transportation and office equipment, refrigerators, grocery counters, testing equipment, display racks and shelves, and neon and other signs which are contained in or attached to a building. In this picture you see on the screen, this represents a typical retail store like many of you have shopped at. And based on my observation of this picture, the items listed on the left are potential Section 1245 tangible personal property that could be depreciated over a 5-year recovery period. In an industrial building where some type of manufacturing is going on, It's very common to see dedicated supply water and wastewater systems supporting the manufacturing process. It's also common to see fume exhaust systems. The manufacturing equipment also usually has dedicated electrical switchgear and distribution systems. There can also be an emergency generator, HVAC for special temperature and humidity requirements, and structural framing to support bridge cranes. All of these are great examples of personal property. We would consider these assets to be accessory to the taxpayer's line of business. These assets differ from those that are essential to the operation or maintenance of the building. These phrases, accessory to the taxpayer's line of business or operation or maintenance of the building, these are general concepts that have been discussed repeatedly in court cases over the years. During a cost segregation study, we rely on our expertise in applying these concepts to determine which assets within the building can be depreciated as tangible personal property. When referring to land improvements, most tax professionals are thinking of asset class 00.3 from Revenue Procedure 8756, which defines land improvements as any improvements directly to or added to land, which such improvements are Section 1245 property or Section 1250 property, provided such improvements are depreciable. This asset class goes on to give examples of land improvements, and it lists sidewalks, canals, sewers, wharves, fences, landscaping, and so on. For most taxpayers, the identification of land improvements is very beneficial because they have that 15-year recovery period and they're eligible for bonus depreciation. And we'll talk more about what that translates to in the slides to come. The picture on the right shows a typical walkway in an office park. And as you can see, there are many land improvements to be identified in this picture. Cost segregation really should be one of the most common tax planning tools for taxpayers that are investing in real estate. The study can be done in the year the asset's placed in service, or it can be done in a later year, allowing the taxpayer to take advantage of the extra deductions when they're most useful. If they're done in a later year, there's no need to file amended returns. Instead, the taxpayer files a Form 3115 to catch up on missed deductions from prior years in the current year. A good rule of thumb to remember is that when it makes sense to consider a study when the depreciable building basis, that is excluding land, exceeds $750,000. However, for residential rental properties with depreciable basis between $150,000 and $500,000, KBKG has actually developed an online software tool that can even efficiently address those properties too. There's a link here on this slide that will actually take you to that tool. Let's touch on some tax considerations. When you're considering a cost segregation study, it's important to remember the following bullets. First of all, depreciation deductions will reduce alternative minimum tax. Bonus depreciation can apply to reclassified items in a cost segregation study of a new construction project. That's also true now for acquired property. Any unused deductions can be carried forward to the future tax years. When a building is sold, the taxpayer or seller must recapture depreciation taken on the tangible personal property. Accounting method changes are addressed with IRS Form 3115, which means you get to retroactively go back and address those buildings from the prior tax years, like we were talking about earlier. Passive activity rules can offset the benefits of cost segregation, and we'll talk a little more about that. And certain 1031 exchange rules also need to be considered. When a building is sold, the taxpayer or the seller must recapture depreciation previously taken on personal property. Section 1245 recapture is calculated at ordinary tax rates, which leads us to recommend holding the property for at least 5 years when considering a cost seg study. When a property is sold, the fair market value of Section 1245 property may be uncertain. The seller can minimize recapture by allocating more of the sale price to real property instead of personal property. In many situations, personal property in a building might have little or no value. For example, carpeting installed, say, a decade ago likely has minimal worth today, especially if the new owner has plans to replace it. In this case, it would be appropriate to allocate only a nominal amount, if any, of the building's sale price to the carpeting. So a proper valuation of the personal property can help yield lower overall recapture tax at the point of sale. The Tax Cuts and Jobs Act created a new limitation on business interest expense, which applies to all businesses regardless of form, on the deductibility of net business interest expense that exceeds 30% of a taxpayer's adjusted taxable income. The good news is that the Act provides an exemption from the limitation on interest deductibility for taxpayers other than tax shelters whose average annual gross receipts do not exceed $25 million for the 3 preceding taxable years. I know for the clients we serve, that sweeps in a lot of our clients, not have to worry about this. Taxpayers that are considered to be in a real property trade or business have the opportunity to elect out of the limitation on interest expense deductions. However, the electing taxpayer is required to use the alternative depreciation system then for depreciable real property. The ADS recovery is 40 years for commercial buildings and it's 30 years for residential rental property. Technically, qualified improvement property was deemed to be 39 years under Tax Cuts and Jobs Act, and so it would have gone to 40 years under ADS. However, the recent CARES Act corrected the QIP recovery to be 15 years under the general depreciation system and 20 years under ADS. So the result of the mandatory requirement to use ADS is that bonus is not available to the taxpayer. And so if you're required to depreciate your QIP over 20 years, then you don't get bonus on it. However, the ADS requirement only applies to the taxpayer's real property. So any personal property can continue to be depreciated using the general depreciation system recovery lives and receive the bonus treatment. The bonus depreciation rate was increased to 100% for eligible property placed in service after September 27th of 17, and the new rate is applicable through 2022, and then it's scheduled to reduce 20% each year after that. The bonus rates can be extended an additional year for long production period property and non-commercial aircraft. To qualify as long production period property, an asset must have a recovery period of at least 10 years, be subject to Section 263 Cap A of the Internal Revenue Code, and also have an estimated production period of 1 year and a production cost exceeding $1 million. It also has to have been acquired subject to a written binding contract entered into prior to January 1st of 2028. A couple of items to note here about bonus depreciation. First of all, when there is a step up in basis due to Section 754 election, the step up can receive bonus treatment as long as the new partner didn't have a prior depreciable interest in the property. If the taxpayer had a prior interest in a portion of the property and now acquires an additional interest in that same property, the additional interest can be eligible for bonus, assuming all other bonus criteria are met. Now, for a step up in basis that's due to death, where a property is passed from a decedent to an heir, in that case, the property is specifically excluded from bonus treatment. On March 27th of 2020, the government signed into law the Coronavirus Aid, Relief, and Economic Securities Act to provide many Americans and businesses too economic assistance and tax relief. Probably everybody on the call is more familiar with this than they really want to be in some cases, but the CARES Act of 2020 doesn't directly address bonus depreciation rules, but its legislation is worth noting because of its effects on bonus depreciation considerations for taxpayers with qualified improvement property or with Section 163J elections. Both QIP and business interest expense limitations are discussed in greater detail later. But the CARES Act provides a technical correction for the depreciable tax life of qualified improvement property, taking it from 39 years to 15 years. And we mentioned this a little bit ago, but that made the correction retroactive for improvement property placed in service on January 1st of 18 and after. Prior to the CARES Act, the Tax Cuts and Jobs Act constrained the ability to use net operating losses to lower tax liabilities. Tax Cuts and Jobs Act restricted carrybacks of net operating losses generated in tax years after December 31st, 2017, and limited carry forwards to just 80% of adjusted taxable income in any given year. The CARES Act now allows taxpayers that have NOLs generated in tax years beginning after the December 31st of 2017 and before January 1st of 2021 to be carried back to each of the 5 preceding taxable years. Businesses that paid federal income taxes in 2013 through 2017 may be able to claim a tax refund as a result of 2018, 2019, or 2020 net operating losses. In addition to the 5-year carryback rule, the CARES Act suspends the 80% limit on carry forwards, allowing NOLs to fully offset taxable income until the end of 2020. Taxpayers can get refunds by using a change of accounting method, that's using a Form 3115, to maximize their losses in the current year and then carry back to years with taxable income. Qualified improvement property was introduced to us as part of the PATH Act in 2015, and it was effective in 2016 and going forward. And as discussed before, several special qualified asset classifications were removed as part of the Tax Cuts and Jobs Act. Most notably, qualified leasehold improvement property was removed with the intention that QIP would replace all of them. There was also qualified retail property, qualified restaurant property. There were several that went away. Qualified improvement property are improvements made by the taxpayer that are to the interior of a building after the building was originally placed in service, and they must be made to commercial, non-residential buildings. They cannot be an elevator or escalator. They cannot be an expansion or components that are structural in nature. The definition has some similarities really to leasehold improvement property, but does not have to be completed pursuant to a lease and can be for improvements made to a building common area. Also, they can be improvements made to a building at any point after it has originally been placed in service. There's no 3-year-old building rule restriction like there used to be for leasehold improvements. So as long as technically speaking, as long as the qualified improvement property is on at least a day after the original building is placed in service, theoretically, it could be qualified improvement property. Prior to 2018, QIP was recovered over 39 years and was 50% bonus eligible. And there was a brief period in the final quarter of 2017 for which the regulations confirmed that QIP acquired and placed in service after 9/27/17, but before January 1st of 18, was eligible for 100% bonus, even though it was recovered over 39 years. But the larger issue was that Tax Cuts and Jobs Act removed QIP from the list of property of a specific type for bonus, and then in a haste in which the law was written, failed to add language clarifying the congressional intent that QIP would have a 15-year recovery period. So as such, many taxpayers that completed qualified improvement property projects in 2018 and 2019 depreciated their property and filed tax returns treating qualified improvement property as 39-year property with no bonus depreciation. However, after passing of the CARES Act, the recovery period of QIP has now been reduced from 39 years to 15 years, which makes it eligible for 100% bonus depreciation all the way through 2022. And this change is retroactive back to January 1st of 2018. There are certain types of property that are specifically excluded from bonus applicability. In situations where the taxpayer is required to use the alternative depreciation system, the bonus is not applicable. Examples of this would include property that's used outside the United States, tax-exempt use property, and tax-exempt bond-financed property. However, using ADS to determine the adjusted basis of a taxpayer's qualified business investment or the adjusted basis of a taxpayer's tangible assets for allocating business interest expense between expected and non-expected trades or businesses. This activity does not cause a taxpayer's tangible property to be ineligible for bonus depreciation. Also, excluded from treatment is property primarily used in certain regulated public utility trades or practices. This exclusion would only apply to property acquired after 9/27/17 and placed in service in tax years beginning on or after January 1st of 2018. There was an example added to the 2019 final regulations to clarify that 100% bonus does not apply to self-constructed property of a regulated public utility if construction began after September 27, 17, and the property is placed in service in a tax year beginning after 2017. Some other property excluded from bonus depreciation is property used in a trade or business that has floor plan financing indebtedness if the floor plan financing interest related to such indebtedness was taken into account under Section 163J1C. Dealerships are the common example where floor plan financing is used. For those dealerships where the operating entity leases from a related real estate holding company, the real estate company can still take bonus on the real estate. The 2019 proposed regs also provide rules that floor plan interest is not considered taken into account for a tax year if the sum of business interest income for the tax year and 30% of the adjusted taxable income for the tax year equals or exceeds that of the business interest as defined in Code Section 163J5. And this test is made annually. In order to be bonus eligible, property generally needs to be placed in service after 9/27/17 and before January 1st of 23. When determining that placed in service date, the new regulations are generally the same as the former rules outlined in Section 168K-1B5. When buildings are newly constructed, we normally look to the certificate of occupancy date to define when that building should be placed in service. For acquired buildings, we look to the ready and available for intended use standard. It's possible, you see, to acquire buildings that are not ready and available for use when you acquire them. Perhaps the interior is unfinished, or there may be plans to gut and renovate the interior in order to attract tenants. But once that building is ready and available for use, then you can begin recovering the cost of it through depreciation deductions. Qualified film or television production is treated as placed in service at the time of initial release or broadcast, and a qualified live theatrical production is treated as placed in service at the time of the initial live staged performance. For self-constructed property, this includes property constructed by the taxpayer for its own use, as well as property constructed on their behalf. Self-constructed property is not considered acquired until the taxpayer begins manufacturing, constructing, or producing the property. An optional safe harbor allows the taxpayer to determine the effective acquisition date as the date when 10% of the total construction cost has been incurred or physical work of a significant nature has begun. If more than 10% of the project was incurred prior to 9/28/17, the old bonus rules will apply, including the old phase down of the bonus rate, meaning 50% bonus in 2017, 40% in 2018, and 30% in 2019. The component election was introduced with the proposed regs, which potentially allows the taxpayer to bifurcate the project between portions completed before and after 9/27/17. As our examples show, this can enable a project that does not meet the safe harbor test to still qualify for the new bonus treatment for at least some of the project components. Let's look at bonus depreciation in light of the 1031 exchange. There's been a lot of discussion in our industry about the impact on 1031 exchanges. Based on our understanding of the Tax Cuts and Jobs Act and proposed regs, cost segregation should still be beneficial on both sides of the transaction. There are several reasons that support this viewpoint. First of all, committee reports suggest that there's no intent to change the nature of 1031 transactions for real estate. Secondly, personal property from cost segregation is considered real property under state law, typically. And third, matching of 1245 is still required to avoid recapture. So all of this tends to point to the logical conclusion that you should still be able to include the kind of things we're calling tangible personal property in a cost segregation study as part of the 1031 exchange. With respect to bonus depreciation, however, the bonus would only apply to the excess basis in the replacement property. Any carryover basis would not be eligible for bonus. Now, before we leave the slide, I should point out that the IRS recently, I mean June 12th, published proposed regs that take a much more restrictive view of what might be considered personal property within a real estate transaction. And those regs are still in the comment period, so it really remains to be seen how this will ultimately be settled. Section 179 allows businesses to deduct the cost of purchasing qualifying equipment and software. For 2018, the deduction limit has been increased to $1 million. For the 2018 spending limit cap was $2.5 million, and that means there's a dollar for dollar deduction in the $1 million deduction limit for every dollar that's spent in excess of $2.5 million. So if the taxpayer spends $3.5 million on 179 eligible property, they would effectively eliminate their capacity to use the 179 expense. The Tax Cuts and Jobs Act added on something different, a new twist. It permits the 179 expensing for roofs, for HVAC, for fire alarm and fire protection systems, and also for security systems. This is only applicable to commercial buildings. It doesn't work for residential, and it's limited to improvements made after the building was first placed in service. Generally, the rules in 179D5 will also prevent most non-corporate real estate investors from taking advantage of this 179 expensing treatment. So I have an example here. Suppose a client purchased an existing 10-year-old building in 2018 for $4 million, and before placing it in service, they put in a new roof, HVAC, fire protection, and security system for $500,000. All of that is 179 eligible. And you might be thinking, how can this be true since the improvements were done before the taxpayer placed the building in service? But the key here is the building was originally placed in service 10 years ago by some other taxpayer. So the first placed in service requirement that I mentioned was actually satisfied. $179 expensing now includes personal property used for furnishing lodging, such as furniture and appliances in hotels, apartment buildings, and student housing. Something to consider is that there's no real benefit to taking the 179 expense on tangible personal property that's already eligible for 100% bonus depreciation. Taxpayers, in a lot of cases, would probably be thinking of using 179 expensing on items that aren't otherwise eligible for bonus depreciation, such as roofs and HVAC equipment. Please do note that taking the 179 expense makes them subject to recapture. We're going to turn a little bit of a corner and talk about some tax issues and planning ideas. The new Revenue Procedure 2020-25 allows you to use a 3115, Form 3115, to change incorrect qualified improvement property from 39 to 15 years. And for a limited time, you can use the 3115 with change number 245 to change and revoke elections. These elections are related to ADS, electing in and out or a bonus, electing 50% versus 100% bonus on assets that were acquired in the 2017 tax year, and allowed to make all these changes on one 3115 form. We have a link here to the KBKG resources page where you can find a sample Form 3115 template that you can download. And you'll also find we have our QIP reference chart there, and that's been updated and provides the current QIP definition. Let's look at the passive taxpayer and the self-rental rule and grouping election. Many taxpayers have operating business entities that obtain a property and then turn around and rent it to themselves. The self-rental rule generally does not allow the losses from your real estate company to offset the income from your operating entity. In my example here, our retail business is making $100,000 of income, and our real estate entity has a $100,000 loss because we did a cost segregation study and got all that bonus depreciation in year one. Since the self-rental rule says we cannot use the real estate losses against the S-Corp income from the retail business, we end up paying about $40,000 in tax. This has to do with the passive activity rules. The grouping election should be considered if the real estate is actually being used by the operating entity and both entities have the same owner. This election allows you to group the activities and use the losses from one business to offset the income in the other business. Under this scenario, that same owner with $100,000 of income in the retail business and $100,000 of losses from the commercial rental property will pay zero tax because they fully offset one another. The taxpayer can only make this grouping election to aggregate these activities when the entities qualify for grouping. The election requires an attachment of a formal statement to the return. Cost segregation can be a useful tool in estate planning. I bet that surprises a number of people listening. For this strategy, let's start with some basic rules related to estates that involve real estate. When a building owner dies and a property is inherited that is appreciated, any gains that were built up during the decedent's life are completely forgiven. The beneficiary receives a step up, which means the property's new tax basis is reset to the fair market value of that property on the date of death, and now the depreciation starts all over for the beneficiary. This provides an opportunity to apply a cost segregation study on the decedent's pre-stepped up basis, which creates another example of a permanent tax deduction. To illustrate this, let's look at a building that was purchased by the decedent 6 years ago, where the death happens in August of the current year. Since the original investment of $1 million is considered residential rental property, it is depreciated over a relatively long life of 27.5 years, straight line. So by the time of death, the decedent will have roughly $728,000 of depreciation that he never got to take. The decedent will need to still have a final tax return prepared for the period in 2018 that he was alive. Now, suppose the decedent had sold the property for $2 million before death. They would have had a taxable gain of $1.27 million. But that doesn't happen in our situation, though, since the current estate tax rules forgive any taxable gains built up by the decedent. The beneficiary gets that full step up to the fair market value of the property on the date of death, in this case of $2 million. The beneficiary now records the $2 million basis on their tax return going forward. Most CPAs already know that doing a cost segregation study on that $2 million stepped up basis is a great idea. But what many tax preparers can overlook is the time-sensitive opportunity here to apply a cost segregation study to that pre-stepped up basis. This allows the decedent to claim even more depreciation deductions before the death, lowering further the building's tax basis and creating an even higher step up to the fair market value. The idea here is to take as much depreciation before the death, since the heir gets step up anyway to the full fair market value, regardless of the decedent's basis. This strategy typically yields the greatest benefits for the estate because these deductions would otherwise be lost forever if not taken on the decedent's last tax return. When we conduct a cost segregation study on the building as of its 2012 purchase date, we identify items in the building purchase price that should have been depreciated with shorter tax lives. In our case study, a cost segregation study identified $200,000 of things like cabinets, ceiling fans, and appliance-related electrical that can then be recategorized as 5-year property. It also identified another $100,000 of things like parking lots and landscaping and fencing that can be recategorized as 15-year land improvements. Since the decedent should have written these off much quicker than the 27.5-year life that he used, the IRS allows him to claim any missed deductions on his final tax return using a Form 3115. In our case study, when the decedent's final tax return is filed, along with Form 3115, they claim missed depreciation deductions of approximately $174,000. And as discussed, this lowers the decedent's building's tax basis, but that's okay since the heir gets a step up to fair market value regardless of the decedent's basis. Because these deductions should have been lost forever, the result is a permanent tax savings just over $68,000. Now, I mentioned this needs to be done on the decedent's final tax return. That's because when a building is acquired in a tax year prior to death, in order to apply a cost segregation study, a 3115 is required, and generally, you cannot file a 3115 on an amended return. So from the heir's perspective, they now get to step up the basis to the current fair market value and begin depreciation all over again. And since they've already had a retroactive cost segregation study done on the property, they can now have that study updated to reflect the new fair market value step-up basis at a minimal cost. This allows the heirs to maximize deductions on the new basis. The slide before you now is a snipped image of what we call our Qualified Improvement Quick Reference Chart, and it's available to you at the address there on our website at kbkg.com/resources. Many of our CPA clients love this chart and keep it handy. I personally keep it on my desk, and many of my colleagues who are competitors of mine tell me they also keep it handy. We pass it out to clients. It's our most popular download. I'd encourage you to take a look at it, as it summarizes everything we've talked about in regards to qualified property and bonus eligible dates. You're probably wondering, how long does it take to complete a study? Typically, a cost seg study will take between 30 to 60 days from the time all information is received. That's an important factor. But once we have everything we need to go, 30 to 60 days, and it's a good idea to plan ahead for those tax deadlines. If you need it for March 15th, we recommend engaging as early as possible so that projects are in their queue for a timely delivery. And in terms of the cost, it's typically between $6,000 and $16,000 for most projects. It generally depends on the size and type of the building. It depends on if there have been additional renovation costs on top of the building acquisition. Did the renovation span multiple tax years? And as I mentioned earlier, we have this tool out there, the Residential Cost Segregator, that allows us to address residential properties that are under $500,000 in basis. That's a great tool that brings cost seg to taxpayers that didn't really have a way to get it done before. This slide talks about how you evaluate a cost seg provider. I would say definitely recommend that you seek out a certified cost seg professional so that you're confident in the quality of the work that you're getting and the deliverables that are produced. I think you should evaluate the resumes and bios of those who are going to sign the report. And if a firm withholds that information, beware. Find out how long the provider has been doing cost seg studies and how many they performed. Consider their experience with the tangible property regulations. Will they be prepared to address retirements and dispositions, repairs versus capital expenditures? Consider their experience with 179D and 45L green building projects. Will they be prepared to identify these opportunities and address them for you? Consider who you want defending you if the study goes to an audit by the IRS. Consider the resources available to the provider. If they're a low cost or small provider, they may not have the resources necessary to stay on top of all the tax issues. And as we bring this thing into a finish, I've thrown in a few slides here, just a real quick slide that shows some of the other services that are available at KBKG. The 45L residential energy credits, the recent tax extender legislation in December extended the energy efficient home credit to developers of energy efficient homes and apartment buildings. The 45L tax credit originally was made effective on January 1st of 2006. It offers a $2,000 per dwelling unit credit to developments with energy consumption levels that are significantly less than certain national energy standards. So we have a whole team that focuses on this. For commercial buildings, there's a deduction, the 179D deduction. The energy efficient commercial buildings tax deduction, which also was made effective on January 1st of 2006, is a significant financial incentive geared toward building owners, tenants making improvements, and architects, engineers, and other designers of government buildings. To qualify, new constructed buildings along with improvements to existing buildings have to meet or exceed energy reduction requirements. And recent tax legislation, again, extended this deduction, offering a tax deduction of up to $1.80 a square foot to those investing in energy efficient improvements that were placed in service after December 31st of 2005. The R&D tax credit's another service that's available. It's primarily a labor-based incentive that's designed to promote innovation within the United States. It was first enacted in 1981, and it's been one of the most valuable credits leveraged by companies. Every year, the R&D credit yields billions of dollars in federal and state benefits to companies that are engaged in qualifying research. Thousands of companies take advantage of the credit across multiple industries. And even so, I'm always amazed at how many companies either aren't aware of it or don't think they qualify when they really do. Transfer pricing is our newest service line. The partner over this group is an economist with many years' experience consulting with multinational companies on this issue. Thanks to the tax rate changes implemented by the Tax Cuts and Jobs Act, we're finding many multinational companies would benefit from a transfer pricing study to reduce their overall global effective tax rate. The interest charged domestic international sales corporation, for obvious reasons, shortened to ICDISC, offers significant federal income tax savings for making or distributing U.S. products for export. The ICDISC was originally created by Congress to promote export sales by allowing companies to defer income with interest charged on the deferred tax. Now the ICDISC provides significant and permanent tax savings for producers and distributors of U.S.-made products that are used abroad. And then the fixed asset tax review, the IRS issued comprehensive repair regulations regarding the deduction and capitalization of expenditures related to tangible property. And those regulations are commonly referred to as the repair regulations or the tangible property regulations. These regs are applicable to businesses in all industries that acquire, produce, replace, or improve tangible property. Application of the repair regs requires an in-depth understanding of various tax cases and circumstances that have to be met. The repair regs mostly affect real property and can provide significant benefits even if a cost segregation study has already been performed. IRS procedures allow you to apply these rules retroactively and claim any missed deductions using Form 3115. Correcting these errors is considered an automatic change of accounting method and does not require amending any returns.